Good evening, everyone. Welcome to our Texas A&M University Homebuyer Workshop. My name is Jason Maida. I'm going to be your host for this evening. It's great to get a chance to see everyone. I know probably depending on where you're at in the country, it could be actually good afternoon for you as well. So wherever you're at, we want to welcome you to our Homebuyer Workshop. Really excited to bring this installment to you. We teach 4 of these classes for the alumni throughout the year. Usually once a quarter, we bring this workshop material to you. We have a large audience for tonight and are really excited to be able to present all these material to you. We try to make our sessions very interactive with you. So as I go through tonight's presentation, we encourage questions from our audience. You can ask questions by using the Q&A function in Zoom, and then myself and my colleague Ken will do our best to answer those questions either on air or we'll reply to the group with the answer to your question. Now, I know our audience is from all over the country, so if you have a moment, drop in the chat where you're joining us from. When we talk in these classes, we kind of focus in on market data, so it would be really interesting to see kind of where the larger audience is at, because when we get into our housing market section of tonight's class, it'd be interesting to see kind of where you're at and where maybe you're thinking about purchasing whenever that comes up as as your goal for you. So love to kind of know where you guys are joining us from. All right, and so a lot of us from Texas, San Antonio, Houston, Dallas, College Station. All right, Fort Worth. So we got some folks from Louisiana. Awesome. Very cool. Missouri, Arizona, Boston. Yeah, so we're all over the place. So that's awesome. So we're all in different time zones too. I love that. So I really do appreciate everyone taking time out of your busy schedules to take on this content. And all of our class material tonight will be shared back with you tomorrow morning. So since you've subscribed to our presentation, of course, we're going to go ahead and send you all the presentation material. We're also recording tonight's class, so we'll have that available, recorded version out to you as well tomorrow, and that'll also be up on our YouTube channel as well. Okay, so let's go ahead and dive in. I'm going to go ahead and start screen sharing with you, and we'll kind of dive into tonight's material. A little bit about American Pacific Mortgage, if you have not heard about our company. So we're a nationwide lender, so we work all across the United States. Our corporate headquarters is out of California, but we have offices spread out, brick and mortar offices all across the country. Now, as you probably know, especially in today's day and age, a lot of our stuff we do on video or phone, email, of course. But so we can serve all of our clients across the country through one of those different platforms. A little bit about me. My name is Jason Maida. I'm a branch manager, originator, and kind of an educator with American Pacific Mortgage. So I present classes like this all across the country through our different partnerships we have. And of course, we love our partnership with Texas A&M alumni, and really excited to be able to bring this information to you. Tonight you're going to learn about a variety of different topics. We're going to talk a little bit about the housing market. We're going to look at interest rates. We're going to spend some time looking at a budgeting exercise in terms of like what does it look like to look at renting versus owning. We'll spend some time giving you some tips and resources around credit. We'll look at student loans and how those can impact qualifying for your upcoming home financing. We'll also talk about some of those loan programs as well, and then look at documentation that we need to support our application for home financing. We'll spend a little bit of time looking at first-time home buyer programs, and then we'll wrap up tonight's session looking at the workflow of buying a house. So after tonight's class, to say, you know what, I think I want to learn a little bit more about home financing and maybe set some goals and objectives to purchase a home, whether this year or next year. We're going to walk you through the workflow of buying a house and share with you a little bit more about what a personal consultation might look like and helping kind of support you with resources on this journey towards homeownership. Well, again, tonight's class is going to be very interactive. We encourage you to ask questions. Now, again, we have a very large group too. We have a large participation of alumni that's going to be a part of this class tonight. So bear with us. We're going to do our best to get through all the questions that come about. And then if I don't get into some of those questions during the presentation, we're going to carve out some time later on for some Q&A. Well, let's think about home buying a little bit more. And does it really make sense for me, right? I think as you're considering home buying, I would encourage you to think more about the benefits of owning a home. I always compare, renting versus buying as it not being like an apples to apples comparison. because there's a lot of great things that come into homeownership, like the ability to be able to control my budget, right? I can kind of control my affordability. I don't have to worry about a landlord increasing my rent over time every time I renew my lease. This home is an asset that will hopefully appreciate over time as my value of my home increases, my balance decreases. The difference between those two numbers is my equity that I have in my home, and that's an asset that will hopefully pass along to help create generational wealth, if you will. There's also some really great tax benefits that can still come along with owning a home, potential deductibility of interest. So when we kind of measure up renting versus buying, we encourage clients to think a little bit more about their budget with all the great value add items that come along with owning a home. And I think as we kind of launch in tonight's class, a great way of kind of putting that together for you is to do what we call as a rent versus buying exercise. So I'm going to switch screens here and kind of take you through a calculator that's going to walk you through a rent versus buying exercise. We're going to kind of we have some of these data points kind of pre-filled in just to keep us on track with our class tonight. By the way, our class is going to run right about to the top of the hour, but we'll still kind of interweave in all those questions that you have from our audience. All right, so here's kind of the calculator, and we're going to walk through an example for our audience tonight. Let's assume we have a monthly rent of about $2,000 a month, right? I know that's going to vary depending on where you're at in the country, but let's say we have $2,000 a month in rent. We're going to add in our monthly renter's insurance of about $15 per month. We assume that our rent is going to go up about 5% every time we renew our lease. So on an annual basis, basically, right? And then our next tab in this calculator is our home purchase. And we're going to assume that we're going to purchase a home of about $450,000. Again, that's going to vary depending on where we're at in the country. But as you're going to learn a little bit later in tonight's class, the minimum down payment to buy a home at a $450,000 purchase price is 3% of your purchase price. We also have property taxes that we want to factor into the budget exercise. We want to assume that we're going to have homeowners insurance as well to insure our home against any type of damage, whether it's theft, vandalism, fire, flood, that kind of stuff, right? We're going to have that with homeowners insurance. So we bake that into our budget. We have maintenance costs of our home that we want to factor in. So all those get kind of added into basically the home that I'm going to purchase. Now, we also want to think about our financing, right? And that's part of what our class is about tonight. So we're going to assume a 30-year fixed mortgage for our home financing. We assume an interest rate of 7%. And we're going to talk more about interest rates in just a few minutes. We also have to think about the cost involved with buying our house. In financing, there will always be kind of closing costs, which are origination charges from a lender. Now, one of the great things we have with our partnership with the alumni at Texas A&M is that we actually discount our services for you. We discount them by $750 as an added benefit for you and the alumni. And then there's discount points that you can elect in home financing to help basically reduce your interest rate for your financing. Now, it comes with a cost, and those are points. Points are generally 1% of my loan amount. So let's say I was financing $400,000. I paid 1 point. That would be $4,000. That will generally equate to about a 0.25% reduction in interest rate. Okay, we're going to learn about characteristics of interest rate scenarios here in just a few minutes, but I want to kind of give you just a high level of discount points. And then we have other settlement services that are also under the closing costs umbrella. Those are things like title and escrow fees. Some states we have to use attorneys to procure our home purchase, transfer taxes to transfer the ownership of the home. Generally speaking, closing costs for my home can on average be about 2 to 3% of my purchase price. So if I'm thinking about saving for my home purchase, right, I'm going to generally have to save up for my down payment plus those closing costs, which again are about 2 to 3% of my purchase price. Now, the other factor that we want to add into the other assumptions section is our appreciation rate. So we're going to assume that our home is going to appreciate about 4% on an annualized basis. That obviously differs depending on what the market conditions look like and where we're at in the country. We have expected years in the home, about 7 years. We have the selling costs of our house, because what we're going to do is we're going to put into our formula that I'm going to eventually sell my home in 7 years. And so what does that look like comparing renting for 7 years? We have state and federal taxes. We also have the savings rate factored in at 3%. So what our calculator does here is it's basically going to show us the difference of owning for 7 years versus buying for 7 years, right? So now we have to realize, though, that from a monthly budget perspective, our rent of $2,000 is not going to look the same as ownership, right? Because now our payment on the ownership side is about $3,900 a month versus renting at $2,000 a month. However, our cost opportunity over 7 years is about a $37,000 improvement on the buy side versus renting if I chose to purchase a home. And how I get there is the appreciation of my home over 7 years, as well as the tax benefits that come along with owning a home. So what I would encourage our audience to think a little bit more if we're considering home ownership is all of the kind of the add-on opportunities that come along with ownership, not just necessarily, a monthly budget on your rent equating to what your budget would be on owning, because all of those kind of, like I said, add-ons that come along with ownership. Okay. Now, again, we're going to send out that calculator to you with our material tomorrow morning so you guys can get a chance to run your own calculation, which I think will be really helpful for you as you're on this journey towards home ownership. Now, let's talk a little bit about the housing market. We're going to give you kind of a national housing perspective because, we have a really large group tonight and, everybody's in different parts of the country, right? But there's a lot of kind of baseline characteristics that look pretty much the same in all parts of the market. One is we have not as much inventory as we need to support buyer demands across the country. So there is some inventory challenges out there. Now we're expecting about a 10% inventory increase year over year when you compare the spring and summer buying months. Traditionally, spring and summer are the busiest times of year to purchase a home, right? And over the last 2.5 years, we've had challenges from an inventory perspective because as we look back to the pandemic years, so many existing homeowners were refinancing their home to rates around 2.5% to 3%. And now in today's market, those same homeowners really aren't willing to part with those rates. And so we've kind of created a little bit of a log jam from an inventory perspective. And so builders are trying to fill that void and try to get more inventory there, but they just can't build homes quick enough in most parts of the country. So we have some inventory challenges, but I think we're starting to see a little bit of a release from existing homeowners now willing to put up homes on the market, whether it's because, maybe they're now looking to be, maybe they're empty nesters, they're looking to maybe downsize, maybe it's a relocation situation. So we are starting to see more inventory come on the market. And again, that kind of our projection this year is about a 10% lift in inventory that's available. This is kind of the average sales price. You can see our median sales price about $420 across the country. You can see kind of our chart here shows prices picking up a little bit. Part of that's driven off of just lack of inventory in buyer demand. Now, as we move forward in the 2024 market, interest rates are going to play a major role in really what happens with the housing market. As interest rates eventually go down at some point, what that generally does is brings more buyers to market. And if inventory levels don't change, right, what happens to prices? Prices will start pushing up further. So we're going to be really watching rates carefully. Average interest rate right now has come down just a little bit. It was tipping out about 7.25% last week. It's probably just right around 7%. As you guys have probably seen, and what you're feeling in your own personal budgets is the cost of everything, right? Cost of goods are more expensive. Cost of living's more expensive, and that's all directed around inflation. The Federal Reserve has tried to kind of control inflation by raising interest rates over the last 1.5 to 2 years. And we're still not there yet, although we've seen some signs of inflation improving. The Federal Reserve's goal is to get inflation below 2%. We're still not there yet. And so that's why we're still kind of in the midst of our current rate environment that you can see here on our screen. This blue line represents the 30-year fixed mortgage. Now, if we were to go back into October of 23, interest rates were close to 8%, believe it or not. And then we saw this kind of swift downturn in interest rates to end 23. And then we've kind of had this kind of roller coaster ride of interest rates that we're experiencing now. The question kind of long-term, and I shouldn't say long-term, but in 2024 is like, when are we going to see interest rates start to drift lower? There's some signs that we could see the Federal Reserve cut interest rates at the September meeting, but that's still a little bit up in the air. So a lot of what we've seen in decreased interest rates in the last 3 to 4 days has been really kind of speculation of potentially rate cuts in September. So we'll have to kind of see what happens with interest rates, but that's kind of the moving target that could change the housing climate for us. And of course, it does change buyers' buying power as well, too. Now, when we think about interest rates, it's not a one size fits all situation. There's different credit eligibility requirements for rates. So the higher my credit score is, the potential my lower interest rate is going to be. The product that I select will impact my interest rate. How much I decide to finance, how much is my down payment, right? So if I'm putting 3% down versus 20% down, that could change my interest rate option. And you heard earlier a little bit about discount points that allows me to put more money out of pocket to bring down my interest rate. If you remember that 1 point equals 1% of my loan amount, those are costs that can help bring down my interest rate. Now, all that being said, I'm not a huge fan of interest rate or point buy downs right now. The reason why that is because most investments like that are going to take about 2 to 3 years to break even. And for many of our home buyers that are buying right now, they're probably going to look to refinance in 2025 or even 2026. And so it's hard to get a good return on that investment. So we're not necessarily counseling our clients to take advantage of buying down rates right now. But in some cases, they might need to just to achieve a certain level of budget. And then the term of the loan can also influence my interest rate. So traditionally, we do a 30-year fixed mortgage for most first-time buyers, but in some cases, buyers want a 15-year mortgage. So generally, the lower my term is, the less expensive my interest rate can be. Now, as we get a chance to meet with our clients for consultations and design what we call home buying plans, we're going to talk through all the characteristics that are part of your loan and design the financing options that make the most sense for you, that aligns with your goals and your objectives for homeownership. All right, any questions from our audience before we dive into credit, which is one of our hot topics that come up quite a bit? Any questions from our group? I know we have a large audience, so I want to make sure I can hit questions up as much as possible. Okay, if you have questions, you can drop those in the Q&A, and myself and Ken will do our best to answer those either by typing a response to the group or answering those on air. All right, let's talk a little bit about credit. And when I think about our counseling with first-time buyers across the country, there's usually kind of two challenges that come up for our first-time buyers. One, it could just be savings because I just can't, save quite enough for my down payment, my closing costs. More often than not, it could be centered around credit, maybe because I'm overextended or maybe I've had some past challenges. So what we like to do in our classes is just kind of share with you a little bit more about how to position your credit or optimize your credit score so we can help you achieve your goals and objectives for homeownership. So let's kind of take a look at the FICO score calculation. So just so you understand, there's actually 3 different credit models to scoring. There's the credit card model that you're going to see in most of your monitoring services that you guys subscribe to, like Credit Karma or some of the agencies like Experian, TransUnion, and Equifax. They're going to generally give you a credit card score. Now, if you apply for auto financing, there's an auto score. Then, of course, for mortgage financing, there's the mortgage model. Okay. So what I want to show you here is the FICO score calculation for mortgage. So 15% is going to be how long have I had credit in the mortgage model. So the more mature my credit file is, the higher my score could potentially be. 20% is going to be how much new credit am I trying to obtain? So am I opening new accounts? Do I have new hard inquiries because people are checking out my credit because I'm applying for things? That's going to make up 20% of the score. So we really want to limit new accounts being established or new inquiries because that's going to have a pretty major impact to my credit score. Now, as a side note, as you start this journey in homeownership with our team here at American Pacific Mortgage, we only start with a soft credit check. And the reason why we do that is because many of our first-time buyers are not going to buy next month or maybe even at the end of this year. It could be like a 2025 goal. So we want to help educate you on your credit, but not impact your score. And so that's why we always start with a soft credit check, which doesn't have that impact to your score. Now, 30% is going to be around my revolving credit that's on my credit report. So we call that credit utilization. Simply put, that's our credit limits versus our credit balances. So if I have a $10,000 credit limit in total and I have $5,000 in balances, I'm at 50% utilization of credit. Now, if we're currently sitting at that 50% level, we really want to do our best to try to get below 10% utilization. So get those balances under $1,000, okay? And I totally understand that that may be easier said than done, right? In some regards, especially if, if we're at 80 or 90% utilization, if we're at that level of utilization of credit, then we really want to work our way to get, first of all, below 50% utilization. That's probably one of the biggest areas of opportunity when it comes to credit for some of our clients. Now, let me give you a quick tip to how to manage utilization. So if you have some time, either later tonight or tomorrow, check out one of your most recent credit card statements. Now, there's two key dates I want to bring your attention to. One is the statement or billing cycle date. The second is the due date. The billing statement or cycle date represents the end of the billing cycle for that period for you on your credit card. And the due date, of course, is when you're going to have to pay your bill by that time. Or if it's late after that point, then you might get assessed a late charge. What I would encourage you to do is to manage your credit cards by paying off or paying down your credit cards before the end of your billing cycle date. And here's the reason why I recommend that is because at the end of your cycle date is when the credit card issuer sends out all the data to the credit agencies. And if you could pay that down or off before the end of the billing cycle date, now it gives you a much more improved credit score because my utilization is lower, and then that hopefully will lift up my credit score, okay? Especially as you're preparing to buy, we want to try to get those credit balances as low as possible. Now, the last weighting for the credit score model for mortgage is payment history. That's how I've paid my bills, right? If I've had any late payments, they're going to be rated as 30-day lates, 60-day lates, and 90-day lates. So the more severe my late payment, the bigger impact I'm going to have on my score. We're really looking at impact items in the last 12 to 24 months in that credit model. That's going to give you that's going to be the biggest impact to your scoring. All right, so that's the score model. I'm going to answer just a couple quick questions, and then we're going to kind of go through a couple different other thoughts on credit. And one of those is the questions in the chat was, do we offer any homebuyer assistance programs? So we're actually going to talk about that in the latter stages of tonight's call. So we're going to go into some state-specific first-time buyer programs, and I'll kind of cover that as well too. Another question was, my credit score is very low. What is the best way to boost credit, short-term, long-term? Is there anything I can do to help impact my score? So in scoring, it depends on what's driving the credit score. If it's like legacy items that are like delinquent items, those are a little more difficult to overcome because you can't really churn those as fast. If it's lack of established credit, there's ways to obviously open up a new account, or you can have maybe a family member or partner add you as an authorized user, or perhaps it's around maybe bringing down your utilization of credit. For that guest, I would encourage you get connected with me maybe offline out of this session, and then we can kind of talk through some specific items that could help you on your pursuit of homeownership and kind of helping improve your credit score. I'm going to answer one more question that we'll wrap on credit in just a second. But the question was, what are your thoughts on the mortgage tax credit? What are the requirements? And does it change by state? So the mortgage tax credit is not available everywhere. In fact, it hasn't been available in most areas of the country in the last 3 to 4 years. But ultimately, what a mortgage tax credit it allows you to do is usually 10% of your interest that you pay on a mortgage gets back to you in the form of an annual federal tax credit. But quite honestly, I know in California, for example, it's not available. And most parts of the country, it's not available. But we can certainly talk about that offline for those of you that are interested in that. All right, I'm going to let Kane answer some of these other questions for our audience so we can keep ourselves on track for time and talk a little bit more about on the credit side of things. Now, every loan program has a minimum credit score. So you can see that on screen, and we're going to spend some time looking at those programs in just a minute. But just kind of keep that in mind. We have minimum credit score requirements. And as we meet with you, we kind of figure out which product matches best for you. Now, bigger events on your credit report, like a bankruptcy, a short sale, a foreclosure, the more severe that item is, the bigger impact you're going to have on your credit score. One thing I wanted to kind of note on account closure for our audience is that if you decide to close out a revolving account, you want to be careful with that because there's two things that could happen with account closure. One is you're taking an account that has established history, and when you close it out, it actually pulls away all the history on the credit bureau. So you can impact the length of credit, but also it takes away from another available line of credit that you have, which could also kind of drop the credit score. So you want to be really careful on what that looks like here for you. On the lending side, we always look at the middle score in determining eligibility for clients. And here's what I mean by that. There's three agencies that report scoring, right? There's Experian, Equifax, and there's TransUnion. So if my highest score is 780, my middle score is 760, my lowest score is 740, the score I'm going to use to determine eligibility is 760. Okay, that's the lowest middle score for that borrower. Now, if I apply with my partner's 740, 720, 700, the lowest credit score between the two of us is 720. So in that case, the 720 score would be used to determine my eligibility for interest rate, my program, as well as mortgage insurance that you're going to learn a little bit more in just a few minutes. So, it's really important on the credit score side of, or credit scoring side of things to make sure that we help support you in obtaining the highest level of credit so we can help make your financing as inexpensive as possible. When we think about some of the negative items that may be on our credit report, I get the question about like, how long will it be with me on my credit report? Most things will be on your credit report 7 to 10 years. This is a matrix that kind of shows you how long those items will remain with you on your credit report. All right, let's talk a little bit about student loans. This is a topic that comes up with our clients quite often. And, I do understand federal student loans are back in repayment. And, when we look at home financing and those clients that do carry student loan debt, we have to factor those obligations into our calculations for eligibility. So if you're in active repayment, of course, we're going to take the minimum payment for qualifying purposes. Now, if you're back in school and you're on deferment, or if you have a forbearance, there still is a minimum payment that gets counted into the calculation for the home financing. So usually it's 1% of the aggregate balances for a conventional loan, which you can see on screen here would be like a $750 payment for a $75,000 balance. For an FHA loan, it's 0.5% of my aggregate balance. So in that case, that would be like $375 for the monthly payment. Those clients that are in income-based repayment programs, we can use that payment if that's the repayment program that you're in. Now, I do realize a lot of us are receiving forgiveness, in our federal student loans. That if you're currently in a forgivable program or you have documentation that your student loan's been forgiven, then we can pull that student loan out of the equation. Some of our clients that are in more public service positions, right? They have like 10-year forgiveness. In the now, we would have to count a minimum payment for qualifying. And then, of course, once those debts are forgiven, then that would get pulled out of the equation. Okay. But student loans are something that we're going to kind of talk through as part of a consultation with you to figure out how those are impacting your scores. The balance doesn't necessarily impact the eligibility. It's the payment that we're looking at from a qualifying perspective. All right, let's now kind of shift gears. We're going to talk about loan programs. There's quite a few different loan programs that you can choose as a first-time buyer or second or third-time buyer. But I want to kind of spotlight these 5 programs and give you a little bit more of the characteristics of each one of these programs. So the first one we're going to start with is a conventional loan program. So when we think about conventional loans, those are around Fannie Mae, Freddie Mac loans. You guys might have heard that terminology in the past. Those are not, they're private loans. They're kind of quasi-government loans because they, Fannie Mae and Freddie Mac during the housing, crisis were kind of supported by the federal government, but they're not federally insured. Conventional loans generally have a 3% minimum down payment up to a loan amount of $766,550. That's called the conforming loan limit. And that conforming loan limit is a nationwide number. Now, for those of you that are in high cost of living areas, like, for example, Boston, I think we have one of our guests from Boston, or maybe you're in California, then there's additional or higher loan amounts that you can go to called high balance loan limits. But once we go beyond the conforming loan limit, that minimum down payment raises from 3% to 5%. Now, the minimum credit score for a conventional loan is 620, as we mentioned earlier. So that's on that particular product. The other product that's common for first-time buyers is FHA loans. And those are government insured loans. It's a minimum down payment of 3.5% of the purchase price. The loan amount generally will vary by the county that you're going to purchase in, but as a rule of thumb, it's going to go up to the conforming limit of 766,550. Now, FHA is going to have a lot more leniency from a guidelines perspective than the conventional product. By the way, as a side note, conventional loans occupy about 70% of all originations across the country. Okay. But on the FHA side, we're going to have a little more leniency from a late payment perspective, or if we've had bigger events like we mentioned during our credit section, FHA will have a little more flexibility from that standpoint, as well as the credit score minimum on an FHA loan is 580 versus a conventional loan at 620. Now, for our veterans that have eligibility for the VA home loan, that's a wonderful product, and that's something we get a chance to help veterans across the country with. The minimum credit score on the VA home loan is 620. There's also a lot more flexibility in the guidelines for the veteran to help that veteran achieve home ownership. Things like debt to income ratio that you're going to learn a little bit later on can go a little bit higher for the veterans product. Past late payments or any type of credit challenges, a little more leniency to help the veterans achieve homeownership. And one of the great benefits about that program, it's a zero down payment option. Okay. So we have some clients that are buying an $800,000 house. They can do that with no minimum down payment. And some veteran products will also work with local, state, and municipality first-time buyer programs. The USDA product is a product that allows you to buy in more rural areas. It's a zero down payment option for clients that are choosing to purchase in rural areas. There's two major requirements with the USDA product. There's income requirements for the household, and of course, there's location requirements. That is a USDA insured loan, so it's a federally insured loan. And with that program, there's two components to the expense structure of that loan. There's what we call as USDA guarantee fees that you pay 1% of the loan amount up front, plus a monthly fee as well too. And then finally, there's jumbo loans, and those are for clients that need to buy at a higher level. And with that higher level comes a higher contribution of down payment. Usually it's 10 to 15% of the sales price. Higher credit score requirements also on that program, up to 680 credit score or even higher. We're not going to see a lot of first-time buyers buying at the jumbo level. And part of that is because the down payment is a little bit more extensive than what we would see in other products that we can offer, right? There's also other additional asset requirements, like you have to have reserves for a jumbo loan, which those reserves equate to usually 12 months of my monthly payment, which let's say I have a mortgage payment of $7,000. I would need to have an additional $84,000 in assets with using a jumbo loan. Now, when we think about the loan structure that we have as a buyer, if I'm going to put less than 20% down to purchase my home, there's a thing called private mortgage insurance. And what private mortgage insurance essentially does is it insures the lender against default by the buyer. Now, there's two forms of mortgage insurance. There's government insurance or mortgage insurance, which is on an FHA loan, which we'll talk about in just a minute. There's also private mortgage insurance, which is on the conventional loan product. And with the conventional loan product, there's different payment options for a conventional loan. There's monthly mortgage insurance that you can pay as part of your monthly payment. There's split mortgage insurance where we, in essence, split the mortgage insurance upfront and we pay some of it monthly. There's also single premium mortgage insurance where you're basically going to write a check, so to speak, to buy out the mortgage insurance. And finally, there's lender paid mortgage insurance, which allows a buyer to take a slightly higher interest rate to buy out the mortgage insurance. Honestly, the most popular option is the monthly mortgage insurance option. And here's the reason why, because once you reach 2 years in your loan and you have 20 to 22% equity, you can apply to have the mortgage insurance canceled. Now, for those of you that may have even started your home search on Zillow or Redfin before tonight's class, if you use their calculators online, the mortgage insurance premiums are going to look a lot different than what you would see in some of our calculators as a mortgage lender, because PMI is calculated with three major items. It's calculated based upon credit score, how much I decide to put down as my down payment, and how much I decide to finance. So most of those calculators on those sites aren't calibrated to that. So, what you'll find is the premium can be a lot less than what you expected. So here's an example at the bottom of the screen. So if I bought using a $450,000 conventional loan, I had a 740 credit score, and I put down 3% to purchase my home, my monthly PMI is probably about $183 a month. Okay, so that's kind of what we would be looking at. Now, for that loan, in order to cancel mortgage insurance, I do have to have at least 2 years in my conventional loan and 20 to 22% equity. Most of our clients buying this year or that have purchased in 2023 are probably going to refinance their home in the next couple of years to hopefully not only get an improved interest rate, but hopefully to be able to cancel mortgage insurance because they have an improved equity position. Okay, let me answer a question in the chat, and I'm going to kind of just share with you a little bit more about FHA mortgage insurance. And the question is, can military reservists qualify for a VA loan outside of the 180 days of active duty? So great question. It depends on your certificate of eligibility that we would get back from the veteran, from the VA. So if you decide to pursue a VA loan, we would get some of your supporting documents, and then we would submit to the VA to see what your eligibility looks like, to see if you do have entitlement to the VA product. So for that guest in tonight's class, let's talk offline and get a little bit more specifics, and we can help guide you accordingly. All right, so the FHA loan is a government insured loan, another alternative to home financing for our buyers. You don't have to be a first-time buyer. You can be a second or third-time buyer. But with FHA mortgage insurance, there's two components to mortgage insurance. There's monthly mortgage insurance, which is 0.55% of my loan amount, and there's upfront mortgage insurance, which is 1.75% of my loan amount. Now, with FHA mortgage insurance, the only way to cancel the mortgage insurance is to refinance out to, say, maybe a conventional product. Let's look at an example of FHA PMI. So we take that same loan amount that we showed in the comparison on conventional loan. We have our monthly amount is $206 per month, which is the 0.55% factor. And then we have upfront mortgage insurance, which is the 1.75, which equates to $7,800 in upfront mortgage insurance. So from a comparison standpoint, the FHA mortgage insurance is going to be a little bit more expensive, as you can see, than the conventional product. But I would, as we kind of step back for a second, we're going to be kind of counseling our buyers on which option makes the most sense for them, because not everyone qualifies in conventional products, right? And as I mentioned earlier with FHA, there's a lot more leniency, whether it's from a credit score perspective, or it could be from, maybe past late payments, or maybe a larger event that's happened on my credit report. FHA will give us that flexibility we have to help our clients achieve homeownership. All right, so as we kind of move through tonight's class, we're now going to spend some time just talking a little bit about qualifying income, as well as some of the documents that we'll need as we start our journey towards homeownership. So I want to first start with kind of the typical documents that you would start gathering, which generally will need the last 2 years of W-2s, last 30 days of pay stubs. From an asset perspective, the last 2 months of bank statements. Now, if I'm self-employed, we'll definitely need the last 2 years of taxes. Sometimes we need profit and loss statements. So there's a little bit more documents that we'll need as a self-employed individual goes. But those documents are basically reviewed and used in our calculations for verification of income. Now, I want to spend some time talking a little bit about income, because there's some misconceptions in the industry about what really qualifies as income. So there's a 2-year requirement in lending, but I think it's important to understand what that 2-year requirement means, because a lot of people think they have to have like 2 years on their job in order to qualify for a mortgage, which is just really not the case. The rule for financing is I need to have 2 years employment history, total employment history, and or supporting education. So a lot of the examples I give for some of our classes I teach is that, let's say I graduated from school, in the fall, right? I just graduated. I had 4 years at Texas A&M. I graduated with my accounting degree, and now I'm going to go out and start. I started my new job January 1, right? I started that job. I've been on the job only 6 months, but I want to apply for home financing. I could still be eligible because I have supporting education in my field of study matches what I'm doing for work now. So that would allow me to fit the 2-year requirement for home financing. In some cases, I don't even have to be on the job for a full 2 years, right? So I could have just started that accounting job, and then maybe in the summer I switched to a different job. As long as it's full-time employment, those wages could be used right away for qualifying purposes. Now, where the 2-year requirement may get a little bit more challenging for a buyer is around multiple sources of income. So let's say, for example, I'm in the healthcare industry and I work for 2 different clinics, right? And I work for one for 20 hours a week, the other for 30 hours a week. In order for me to count both sources of income, I do have to show that I've been on both jobs simultaneously for 2 years. That's where it might get a little bit challenging. The 2-year requirement also comes into play if I have additional sources of income. Like, let's say, for example, I drive for Uber or Lyft on the weekends. In order for me to count my full-time 40-hour work week job plus my side work with Uber or Lyft, I have to show that I've been able to demonstrate working both jobs for 2 years simultaneously. Some of our clients that are like newly graduated and haven't even started their job are, maybe they have offer letters because maybe they're graduating, this month or next month, but they really want to jump right into homeownership after graduation. In those cases, as long as we have an executed offer letter, at times we can use that offer letter to help that future first-time home buyer qualify for home financing. Now, at times, some clients have other sources of income, like maybe a partner that is contributing to the household income, but not going to be part of the loan application. So if you do have someone that is contributing to the household expenses, now I can't use that income, and it's certainly it helps you on a monthly budget perspective. But in terms of eligibility, the only way we can count that income is if that person is also part of the loan application. At times, we can use other sources of like rental income. So if I'm going to rent out a room and I have a history of doing that, at times some loan programs will allow us to use those additional sources of income. So with income, we also draw kind of a comparison to expenses, and that's called debt to income ratio. It's one of the metrics we use for qualifying purposes to help our home buyers. Now, it doesn't dictate affordability, it's just qualifying. The more important conversation is affordability, which we'll have during our consultation. But what this calculation does is it looks at our pre-tax income versus our monthly expenses. Generally, we don't want that expense level to be more than 43 to 45% of that pre-tax income. So the calculation takes into consideration the mortgage that we're taking out, the principal and interest of that loan, the property taxes on my new house, the homeowner's insurance. If I'm buying, let's say, a condo or a townhouse, it might have homeowners association dues. Then the other debts that I've already responsible for, like my student loan, my credit cards, my auto payments, right? So I take those expenses versus my gross monthly income, and it comes up with a debt to income ratio. Like I said earlier, we don't generally want those expenses to be more than 43 to 45% of the pre-tax income, but it can go as high as 50%. The question I get from a lot of first-time buyers is, well, where do you think my debt to income ratio should be? And of course, every buyer has varying degrees of what they feel comfortable with, they're kind of their comfort zone, right? But for the most part, most buyers feel good around 33 to 36% debt to income ratio. So in the example we have on screen here, you can see that debt to income ratio is about 35.29%. So that would be a buyer that feels pretty good about where they're at from a budget perspective. All right, quick question in the Q&A or chat that came in, which is, it kind of goes back to our income question, and the guest was asking, why wouldn't someone want to add a spouse or partner on the application? And it really just depends. In some cases, maybe the partner maybe has some credit challenges, or maybe the income's not verifiable. And depending on maybe that the main borrower wants to use a first-time buyer program, but maybe that other partner is not eligible for first-time buyer programs. So there's a variety of different reasons. And those are conversations, of course, we'll have during a consultation with you to see kind of really what the right optimization is of your home buying plan. All right, so the last component to kind of building a plan for you is to think more about savings and really ultimately assets that we can use towards our home purchase. Now, as I mentioned earlier, when we kind of launched into our budgeting exercise, we're going to have to save for our down payment, which we've learned tonight is a minimum of 3% of our purchase price. But we also have closing costs, which are generally 2 to 3% of my sales price, depending on what I negotiate with the seller and kind of where I'm buying in the country. And most of our first-time buyers have challenges either on the credit side or the savings side. And one of the things that we kind of coach clients with is a savings plan, because not everybody that comes to a class like this is ready to buy right away, but we want to help kind of support you with resources to get you to home ownership. So one of the things I kind of coach clients with is a savings plan. It's a really simple formula. And what I would say is that if I'm paying, let's say, $2,000 a month in rent, and after meeting with Jason, I feel pretty good about my mortgage payment being around, let's say, $3,000 a month, right? So right now we know the difference between those numbers is $1,000. If I'm not ready to buy right now, what I would encourage that buyer to do is to start making mortgage payments like saving like you're making a mortgage payment right now. And here's what I mean by that is start saving that additional $1,000 into your savings account like you're making a mortgage payment for $3,000. And as your savings grows over time, not assuming interest in a high yield account, but after 6 months, of course, we would achieve a $6,000 balance. At the end of the year, we would have a $12,000 balance. And those are kind of building blocks to home ownership and savings. So that's kind of where you could start on the ground floor for getting ready for your down payment. Now we're going to start we're going to talk more about first-time buyers programs in just a second. Before we do, I want to just kind of spotlight some of the way we document assets for home purchasing. So, of course, checking in savings accounts, we need the last 60 days of those accounts. At times, you can use retirement accounts. And family members can also contribute towards home purchases. So for most programs, there is no minimum contribution that a buyer has to make, but family members can certainly support you as well. There's a full documentation process to, tracking what we call as gift funds, because most assets in a home purchase need to be seasoned at least 60 days. Gift funds, however, do not need to be seasoned. Now, across the country, there's a variety of different first-time buyer programs that can help support usually low to moderate income households and home ownership. Most states have what they call as a housing finance agency that will help provide resources around that. Now, because we have so many guests tonight in different parts of the country, of course, we won't have time to dive into each state's first-time buyer program, but I wanted to give you kind of more of a national perspective on a assistance program as well as a Texas-based program. What I would encourage our guests tonight, if you're thinking about first-time buyer programs as a resource for you, and we'll certainly talk about that during your consultation, we're going to dive into your specific state and see what resources are available to you to help kind of ease the burden on the down payment and closing cost requirement. So nationally, Freddie Mac, which you heard earlier, has a Borrow Smart program, which can provide a grant of $500 to $1,500 towards your down payment and closing costs. I know that may not sound like a lot, but it certainly makes a little bit of a difference in those closing costs for our buyers. Now, specific to Texas, there's the My First Home program that provides up to 5% for your down payment and your closing costs. And the way this assistance works, it's a separate loan aside from your first mortgage, and it can be either set up as a repayable or set up as a 3-year forgivable grant. Depending on the level of assistance you want to take from that program, there's varying interest rate levels that you will have on your first mortgage. So depending on the interest rate and the contribution from the assistance, then the interest rate kind of elevates based upon how much you receive from that My First Home program. So those are things that we can look at as alternatives to help you in home ownership. And again, there's a variety of different programs that are available to you across the country. So they will be state specific for you. Like I know one of our guests is in Arizona. So Arizona has a specific program that we're approved with that we can help kind of provide you some different options there as well too. And I think the takeaway on the first-time buyer resources is to know that it's not something that we would have to save for 2, 3, 4, 5 years to achieve home ownership. There's resources that are available and at your disposal now. It's just hopefully creating more awareness for you about what is available out there. All right, I'm going to answer this quick question. Then we're going to talk a little bit about the loan programs. And the question, which I think is a really good one, how does APM define and classify low, moderate, and high cost of living areas? Is it similar to the cost of living index? So the way APM actually doesn't define low or moderate income, actually Fannie Mae has kind of census tract data that shows low to moderate income across the country. So we can kind of zero in on a particular county and say, okay, that particular county, this is 80% median income. So typically, if you're below 80% of the median income, that's considered low income housing. And then if you're 81 to 100%, that's moderate income. Most first time buyer programs are going to consider moderate income up to 120% of the median income, or like in some states, it's considered 150% of the median income, especially in some of our high cost of living states. All right, let's talk a little bit about, I know we got one more question. I'm gonna let Ken answer that one for us, but let's talk a little bit about the buying process, because I think it's really important to understand, where do we go from here? We've kind of learned a few concepts. We've learned some ideas around home buying. So how do we kind of put that in action in terms of the workflow for buying a house? Well, one of our next stops after tonight's class, if you want to get connected with us for a consultation, that's a 30-minute service that we provide to you to help design a home buying plan. And that's a one-on-one with me to help support you with different resources and tools to help you achieve your goals in home ownership. The output of that meeting would be to issue what we call as a pre-approval. And a pre-approval is a certificate that you receive as a buyer that allows you to really start going out and home searching for homes. The pre-approval is good for 60 days, but it can be recertified at any time. So we have clients that were pre-approved a year ago, and they just haven't quite found what they're looking for. Maybe they have a longer path of savings, whatever the case may be. But the pre-approval gives you kind of a guideline for your home financing, more kind of a baseline of where we should have our budget at. The next stop would be the home search. That's usually the fun part. Usually starts online. And then after that kind of online search, we kind of zero into neighborhoods that work for us. And when we start getting a little bit more serious about a particular area or maybe a house, we can usually use the resources of a realtor to help show that property, to us, right? We would encourage you to connect with a realtor. We have preferred realtors based upon the markets that we serve, but generally the realtor will be an expert in their market. They should know, all the data points that you would need to help make an informed decision. They'll help negotiate your price of your home, and kind of help with inspections during the process. Now, as you're going out and home searching, if you need your pre-approval letter to be amended based upon different prices that you're negotiating, we can absolutely do that. It's not a big deal at all. As we kind of fast forward a little bit, let's say, for example, I find a home that I love and I want to place an offer on that property, right? Okay, let's say the offer gets accepted. Then if that offer gets accepted, we move to step 3, which is called entering escrow. So that means you, the buyer, and the seller have come to terms on an agreement, right? Usually that escrow process, depending on where we're at in the country, is about 30 days. So from start to finish, 30 days until I get my keys to my house, right? Now, it can be shorter at times. We offer a quick close program, but not all states can support that. But the quick close allows us to take that 30 days and shrink it down to 14 days because some markets are hyper competitive that you need that kind of extra edge. But if we get our offer accepted, within a matter of hours, you're going to get a call from our team saying, congratulations, your offer is accepted, and talk to you a little bit about next steps in the lending side of things and schedule you for what we call your follow-up consultation. We go through the design of your home financing. At that point, things start turning for the processing of your loan and some responsibilities on your side. One is you'll have to make what we call an earnest money deposit, which is usually in the first couple of days of the contract period. That deposit will vary depending on where you're buying, but usually it's 1% to 2% of your purchase price. It's an investment that goes into the total out-of-pocket expenses for your home purchase. Now, I mentioned to you we're going to do a follow-up consultation with you as part of our process. During that follow-up consultation, I'm going to be reviewing interest rate options with you based upon kind of our conversations earlier in the pre-approval process. Talk about your out-of-pocket expenses, your first-time buyer options at that time. Make sure you have a really clear understanding of what your home financing looks like. Now, in most parts of the country, as part of the real estate contract, there's what we call the contingency periods, which allow you to do your homework on the property, which include getting your house appraised, getting your house inspected, and getting your loan approved. For most parts of the country, it's about the first 17 to 21 days of your contract period. Now, behind the scenes on the lending side, we're doing what we call the processing and underwriting of the loan. A lot of the more administrative tasks like getting your employment verified, verifying your assets, having our underwriters review everything to approve your loan. All of that is happening within the first 7 to 10 days of the process. Now, as we move further along at step 5, we issue a loan approval for you. At that point in the process, we're probably about 3/4 of the way through the total process. It also brings us to the end of what we call the contingency period. So if you've done your inspections, you've got your loan approved, your house is appraised, you generally will be okay to move forward into the closing phase. In most parts of the country, you'll sign off on that contingency, which ultimately tells the seller that you feel comfortable in your due diligence and you're ready to move to the final stages. It also triggers us as a lender to issue to you a final closing disclosure, which ultimately gives you a 3-day cooling off period of your financing options before you move to the very final milestone. That's step 6, which is closing your loan. That is really in the financing side of things. That's the only in-person kind of milestone really, because everything up to that point is all done via electronic signature. At closing of the loan, you sign final loan documents in person with a notary or attorney. It takes about an hour or so. After you've completed that, you wire in your funds for your remaining out of pocket. And then on the lending side, we wire in the funds for the home financing and any other first-time buyer programs that you decide to elect. Those monies get reconciled by an escrow or attorney's office, and then documents get recorded at the local county recorder's office. They usually record what we call as a grant deed to transfer ownership, and then a deed of trust for your first mortgage that you're electing. Once all those things get confirmed as recorded, then it's the big announcement, because now you become the official owner of the home. I got a chance to make some of those calls today. Best part of my day, because it's a big celebration of home ownership. You know, it's a big step to invest in home ownership. It's probably going to be one of the biggest financial investments you guys decide to make whenever that step occurs for you. And we want to be here to help create that great experience for you and be a support mechanism for you on this journey towards home ownership. But that's kind of what the process looks like. Now, if you're thinking about moving forward and want to learn a little bit more about what your options can look like, I would encourage you to get connected with me for a 30-minute consultation. We get a chance to meet and strategize about different home buying options. It's a free service we provide for all of our clients in our partnerships and all across the country. It does start with you completing an online application. We only do a soft credit check, and then you'll be responsible for uploading proof of income and assets, and then scheduling a video consultation that works best for you. If you have some questions after tonight's class, and maybe you had a specific scenario that you want to run by us, we'd love to get connected with you for an introductory call, and we can kind of dive into your particular situation a little bit more. Here's what the consultation looks like. Again, it's a soft credit check. It's a free consultation, so that's really important to understand that. It's a home buying plan. So we're going to talk more about where do I want to buy? What kind of resources do I need to help achieve my goals in home ownership? Is there things we can do to help improve our credit? Is there budgeting exercises we need to go through to maybe create better savings for ourselves? All of those things we're going to be part of our consultation with you. Beyond that, we have some really great resources that are available to you, like our mobile app. I mentioned to you earlier about different calculators that are available. The mobile has that. It's available for Android and Apple. You can apply for your loan right there. You can follow the milestones of your loan progress all through mobile. Beyond our amazing, partnership with our Texas A&M alum, we have other partnerships across the country too that we're also proud of. But we teach these free classes to help support our local communities in home ownership. So if you do have friends, family, or coworkers that you think would benefit from some of this material, we love to have you invite them to one of our upcoming classes. We teach over 50 classes like this across the country that we can help support our local communities in home ownership. And I wanted to pass along all my contact information to you. So if you do have some questions after tonight's class, feel free to message me. I want to make sure that I get you all the resources that you need to help you in this decision for home ownership. And we love what our clients across the country say about us on our Google reviews. A lot of our graduates, so to speak, of our classes like to share their testimonials right there. And we've tried to put some good resources out on social for you as well, not only on our YouTube channel, but some of our information we put on Instagram. So we'd encourage you to follow us at J Maida Mortgage. So we got us to the top of the hour. I know we have some questions that Ken was answering in the Q&A. I want to kind of open it up now for any questions that you might have. that we can help you with in tonight's class. It's a pleasure bringing this content to you. And I know we had a very large class tonight, but you guys, I really appreciate you taking time out of your busy schedules to listen to what we had to help support you with. So let's go and open it up for some more Q&A, and I'd love to answer any questions that the audience has. Any questions I can help answer for our group? Okay. I think we did it. Well, okay, actually one question just came in. How does the process differ from those who try to build a home? Okay, great question. So, so the process can look a little bit different, because if you're building a home, if you're doing it kind of more a private build versus more production build side, like on a construction side of things, it will look a lot different because when you do construction financing, you're starting with just the land, right? And then you're getting construction financing to build up the home. If you're doing a production build, so if you're using one of the local or national builders, the process will look very similar. You'll just get through about all the way to step 5, and then we'll have to wait for the home to be built, because builders will require you to have a loan approval. But we also have to wait for the home to be done. So we'll go all the way up to step 5, get your loan approved, and then we'll kind of wait for construction to be completed. So it's a good question, which is there any point to scheduling one of these consultations before having a down payment worth or savings already? And absolutely. I mean, these consultations are not just for people that are buying like right now, right? We want to be a partner for you guys to help set goals and objectives to home ownership. I met with clients 2 or 3 years ago that are now buying in 2024. So we want to be a resource for you. So it doesn't have to be a buy now situation. We want to be a strategic partner for you. What's the best way to contact me? There's all my information on screen, so you can message me through one of those ways of getting to me. And Ken and I will be available to be a resource for you guys. Absolutely. Right. I think we're there. Carol, I see your hand raised. If you have a question, feel free to drop it in the Q&A, and I'll definitely answer it here for you. Right. I think. Yeah, I think we did it. All right, everyone. Have a wonderful evening. Thank you so much for allowing us to be part of your evening. It's a pleasure to bring this to you this evening, and I look forward to connecting with you all